Hi, this is Randy Finney with Right Side of the Chart, and this is video number 2 for Friday, April 29th, 2022, aka D-Day for the markets, what I'm calling this. We'll see. Again, like I said in a post, this is the day after the fangs are out of the way. Of course, Amazon and Alphabet, but you can only go down so much in a single day, so we'll know for sure next week. So far, so good. I like what I'm seeing. Qs are down 3% on the heels of the last of those big things reporting. A lot of that's obviously due to the majority of it's due to Amazon. Amazon's getting whacked. Now down almost 14% on the day. But so far they're selling Apple as well. We're back down. I mean, no new material changes. What I'm going to do in this video is tell you, number one, following up on liking what I'm seeing. But we still, still, like I said, support until that's broken. So, as of now, the bull's still holding the line. And what I want to do is updates on, we had several requests. I caught up on some of the recent comments from the last couple days. Had requests for updates on gold, which I gave you. I got a post out, but I'll get on that real quick. A quick update on the video here. Natural gas and crude oil as well, and then treasury bonds. So let me go into those, and we'll loop back to the markets maybe at the end here. But I'll just show you. This is what Apple's looking like so far. And that's what I'm liking, what I'm seeing. They're, blowout quarter, but they've been fading it all day. They faded the early pop. That yellow line right there, this is a 1 minute chart, so that shows you that was yesterday's close line right there. And so, it's been erratic, but steady selling after the initial post opening rip. Actually, you gapped down here, shot up, and they started to rally early on, and then the sellers have just been taken over on Apple so far. But again, you can't write it off. It's still above support on those daily and weeklies like I covered before. So let me dive into the other things and show you that. So let's start with gold, since I got that 60-minute chart out to you today. Remember, the last time I covered gold, the video was a week ago. I think I posted one other chart since then, and been highlighting this level for a while, 1895 as big support. And last time we hit it there, we had positive divergence. I told you that was a hard buy. Then we came down the other day, and I said not a hard buy anymore, because at that point in time we didn't have, I would have preferred, as I said, to see positive divergence. But I went ahead in the video and also outlined, I said it wouldn't surprise me at all. It's just the nature of this market to see a whipsaw. And that's exactly what we got. When we got it, you also put in that divergent low I like to see. So that's it. No guarantees, or never are with anything, but that's as good as it gets. And why is that? This is actually more bullish than if we just bought here and started going up, for two reasons. Number one, because now you have the positive divergence. That could be the catalyst, the technical catalyst, or a trend change. I look for divergent highs and divergent lows. They usually precede trend changes, like the divergent high there, and the divergent low right here, and the divergent high there. Simple stuff, right? Boom, 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 and now hopefully boom. And then I'll take it in a little tighter. So the way this played out, and these are all the same levels on those charts. I posted at least one screenshot last week, and they were in the video. And so, these are levels you can trade off. So when we popped it, as I said, you could take, if you weren't in it or you got shaken out. First of all, I advise wide stops, because I suspected that was a good chance we would have that false breakdown, aka stop clearing run. This is what they, meaning the nefarious powers that be, whether it's algorithmic trading programs, hedge funds, market makers, this is what they do. And so I've almost learned in certain instances to more so than others, I've learned to almost expect and trade off these, and in some cases even taking a breakdown. But what I said last week was, wait, if you recover it, then boom, that is then effective. That at that point, it was only a potential bear trap or whipsaw signal, aka false breakdown. But once you recovered 1895, that was your made it official. And that's where you could have entered long. You would have wrote it up there. Active trader could have booked profit. 1920 is a big level. We had a lot of support on that level back here, here. And then if the flag plays out, remember, it's only a potential bull flag. It has so far all the, it resembles, and it sure looks like it, And you can see there's the impulsive move up, i.e. the flagpole. And if you take the flagpole right there, to the highest point, add it to the bottom of the flag, gives you a measured target, which actually here I'll tell you exactly. No, it doesn't always play out exactly, but you'd be surprised how often these patterns play out pretty darn close. I showed you, a couple in the Nasdaq 100 and QQQ recently. So that would be right now the bottom of the flag if it doesn't develop any further. And so I probably misspoke in the post I got out to you. I was just eyeballing it, to be honest with you. I was looking at that 1942. It is the next resistance, and you'd probably get a little reaction there. But there's a measured target. It's going to take us up closer to that 1957 target right there, a little shy of that. So there you go. And if that happens, that's about a 2.65% gain from where the bottom of the flag. So a little better than 2.5 where we're at now. And again, nothing's changed longer term. That's why I'm not doing daily updates on gold. Long term is this GLD weekly chart speaks to the long term. This was we're going back for decades here. This was a bull market in gold. You have your bull market corrections along the way. The bull market ended there. We started a bear market in gold, which ended in December 2015. We've been in a bull market since. And 130 at the time, when we were back here, I said would be the big level to me when that breaks, because it was resistance, and then boom, we popped it, and that gave us that impulsive thrust up to the recent high, which tested that previous high. And we hit it once again, and there's all my lines now. So I do acknowledge, and I need to point out, there is divergence there, and that divergence could play out. So that would foil my longer-term bullish case. But as of now, just like I'm ignoring divergences on the stock market for the reasons I stated in the previous video, and more recently, right now, I'm ignoring these. And look. Long term, short term, if you're an active trader, then you're probably only concerned about that 60-minute chart I just showed you with the bull flag pattern. You could trade that and get a quick 2-3% on gold if the flag pops, or maybe you're already in it after the false breakdown. But here's what I'm looking at on gold from a longer term perspective. We had this big symmetrical triangle pattern. And that came, within this bull trend. It was a period of consolidation. Remember, nothing goes up forever. Here you had a little wedge along the way that popped. You certainly had a correction. Those were just bull market corrections, and this was a pretty big one. And then when we popped it there, that was bullish to me, longer term bullish, because and it did. It set the direction of the next trend. We rallied up, and we pretty much matched that previous high right there. And so far, so that's the big level. That is pretty much a triple top high for gold for GLD, and again going all the way back to that 2011 high right there. So that's what we need to do. And if we pull back, the max pullback I'd really like to see, I don't want to see it, still have gold as a long-term position, but it would be a back test of the triangle. If you extend that trend line down, you also have the uptrend line of the triangle coming in, and a back test would be around the apex there, so you'd have dual support. Before that, you have about 174 as price resistance. But you zoom in here, if that little 60-minute flag plays out, it could take us here and maybe get a backfill, or be the catalyst, and we just continue on up. And if we can break 185.70, we'll call that 186, it should be a quick pop up to test that high. And if we've already tested that high so many times now, well, that level, I should say, three distinct reactions over the past decade or so. So I think if we can get up there again, we'll probably pop it. So that's my long-term view. Short-term view, 60-minute chart I just covered. And now gold, and that's gold, I'm sorry. And silver will typically follow gold. So for me to be bullish on silver, to be bullish on gold, means I'm bullish on silver unless I state otherwise. But I'll do a quick update. Let me grab that chart right here. Silver 60-minute. Put that down. Only thing that's changed is we had potential divergence here. I was pointing out this wedge didn't play out. Now here's my divergence line right here. I always say the charts are dynamic, constantly changing, therefore so is my analysis, trend lines, support, resistance levels. That is now our divergence that was put in, and the other divergence never failed to materialize. This one we certainly have a confirmed divergence, and as far as a trend line goes, something along those lines. So That's looks like a wedge that just broke out and is being back tested. So if gold can pop out of that flag, silver should follow, and your next stop would be up here about $24 on SI silver futures. Remember with gold, I showed you GC a minute ago. If you put an M in front of the GC, that's the micro gold contract. Same levels as the GC gold futures. Of course, you can trade GLD. That's the ETF or any leverage version of it thereof. And then you have that silver, which is SI right here. Or on the silver, the small contract is gosh, I think it's Yeah, I believe it's QI for the mini, or it's not the micro. I think the mini contract. Same price levels here. It just has a smaller leverage factor, and that's a pretty big level. That $24. You can see it was support back here. So if we can, especially if we can recover that, then that would also be what gold just had, a false breakdown, aka bear trap. You know, when you break down support, they call it a bear trap because short sellers pile in. They got rejected on the back test. But should we recover that, then all those shorts that are maybe targeting more downside will start to cover. They'll go negative at that point. So you'll start to see their stops get hit. So when they cover, they buy. That's what a short seller does when they close a position out, is they're buying the position. And then you have natural buyers as well that will step in, and that's why that'd be pretty powerful stuff if that happens. Right now we're below that support, so I can't say I'm crazy about silver right now. I would much prefer to see 24 taken back. And so, but you have the divergence, and that very well could be the catalyst. Positive divergence, just like this negative divergence was a catalyst for this drop so far. And just like I think it only had PPO divergence there at that point right there, but it led to that nice rally. You didn't even have the RSI divergence. Natural gas and crude oil. Let's do crude first. I'll just tell you this. I'm either going to be right or wrong on my market call, and if I'm right, then crude's probably going to go down, I would say, with a pretty high degree of confidence. And that'll be, as much of anything, a play on diminishing growth expectations. Yesterday we came through, we had the vast consensus was positive but slowing growth in the economy, but still they expected it was over 1.5% plus expansion they thought we'd see in the economy, and it turned out to be contraction. So our first quarter we had negative GDP growth last quarter. That shows things are slowing down. All analysts, they just blame it on supply chain disruptions and shortages like that, and say, and the current theme right now, and the bulls are resting on, and I get it, is that the consumer's still strong and the consumer's still spending. But if that pillar gives way, and keep in mind, there are a lot of these indicators, these economic indicators, including consumer spending and sentiment, they're lagging indicators, and they're dated. By the time you see get the numbers, it's somewhat dated. And remember, the markets are forward-looking. I'm looking at this trend line there. That should have been on there. The markets are forward-looking, and therefore, by the time you read about it, that hey, consumer spending has turned, consumers tucking in their shell, that the market's already going to be down substantially at that point, most likely. And why is it so important? Because consumer spending accounts for over 2/3 of GDP. Which again is the measure of all the goods and services in the U.S. economy. It's the U.S. of A's earnings report, if you will. And so that's what we're watching. And once that happens, then the economists will all go bearish. But at that point, again, NASDAQ 100 is already down almost a quarter. Over 20, close to 25% off its highs. S&P not that much yet, but again, by the time they start telling you on TV and in the papers that get out, we're going to be in a bear market, it's going to be too late. You're going to have missed most of it. So that's where I think technical analysis will shine and get you in and out, get you in early and get you out. In on your longs early at the bottom, and out of those longs early on the top. All right, back to crude oil. So that's it. Basically, here's what I have for you. We have negative divergence on the RSI right now from this point to this point. Here, I'll come in tighter. That's a 3-month chart. Let's just zoom into Before I leave this 3-month chart, let me show you. Here's a pretty significant trend line. And I'm going to jump out. Let me do this real quick, see if I have that trend line on the 6-month chart. I have it differently. I have it, that's the one I just showed you, the trend line that I have on the 3-month right there. And that is a potential target to the downside, and it's also a level, if broken, would usher in more selling. So I'm going to go back to the 3-month chart. But before I do that, let me just show you. Here's what we're doing. We're making a series of lower highs. It's not a perfect triangle, but so far lower highs, but we also still have higher lows. So again, I can't draw a perfect trend line, but that's pretty much what's going on here. Remember, I showed you a big triangle pattern on gold, and the way these things work is, an upside break is bullish and will typically determine the next trend, where a downside break is bearish. If I'm right, and today is D-Day, I'm calling it D-Day, and really into next week. But if the bears win, if they are able to take out the recent lows and those support levels I gave you earlier on the indexes, as well as Apple, and they win, you will most likely see crude going down pretty sharply as demand expectations fall. Okay, let's just take it down a little more granular. Go down here to a 1-month period, and there's that. You can see, so I'm not crazy about it. It's almost flat, almost equal lows or equal highs on the RSI, but it's still divergence. And really, pretty much there as well. That's about, doesn't matter if you, slight hair higher. Pretty much your indicators are making equal highs, but prices made higher highs, and so that's the divergence. If I had a better trend line right there, I'd say that's a wedge break, but either way, it's a pretty impulsive reversal. And see what's going on is stock market's been, holding up recently, but today it's down, and I'm sure there's a lot of analysts and fund managers saying, hey, what's going on today? Apple just had a blowout quarter. Yeah, Amazon, but then again, like I said, it's a common theme. Apple, it's only a matter of time. They're marching out and they're shooting the generals, and most of the generals have already been shot. I'm talking about the fangs, and ultimately they're going to catch Apple, and get him as well, him or her, whatever you want to refer to a stock as. All right, so that's it. I don't have a strong opinion. Somebody asked about crude, but I can tell you, here's your targets. 104 right there. I would target that if you want to short crude. 104. We've danced through this level. These are old lines, but I think they'll still come into play. This one is a little bit heavier weighting, 104. And then if 104 is broken, again, I give you that trend line that's going to come in there. It's kind of sticky. There's just a lot of trading around here, so I don't have solid hard targets right now. But I would say this one's pretty good too, about 99.60-ish. That's a pretty good support level. So there's your targets if you want to short crude. And natural gas, I still think it topped. I've told you that before. I think this was a buying climax, aka blow off top. This is a 6-month chart of NG, 2-hour candles, big run up. This is all the Ukraine, Russia stuff, and it's still, they're still trying to get off the Russian natural gas, but slowly but surely. And you also have seasonality coming into play. And then we took that trend line out. Remember that we went parabolic here. I showed you at the time, which a short entry on it, a couple of them actually. Let me zoom in a little closer here. Let's go to 1 month. Look at the hourly chart. So that was it. So we had this one here. Boom, there was a sell signal, break of trend line. When you go parabolic, what you have, what I'll often note, are a series of different trend lines. You don't see the parabola so well when you zoom in this tight, but it's there. I showed it to you on the 6-month chart, and that's it. So you have a series of breakdowns, and boom, boom, and you can see the levels we're dancing between. This is a pretty big resistance level, resistance zone. It runs from about 7,423 to 7,495 right here. So again, the chart's not that clear to me, but for a swing or trend trade, I'd much rather be short than long right now. But like I said, I can't make a screaming case to do either. If it can push up a little bit higher, you might get some divergence here. You have some potential divergence there on the PPO. maybe on the RSI if it can make another run at this level. Even it'd be nice to see a little false pop above it and then a failure, to give us the divergent, give us that negative divergence, and then set the stage for a drop. I would, if you're short now or you want to short it, and you could short it here, you could short it there with a stop somewhat above. Of course, there you have that big high there. I would target right here, that 6077 level, a little bit above that, obviously, for a near-term swing trade. And I'm going to give you one more. We have these reaction lows here. So there's level right there. You got two lows, couple of highs right there, 649, and then 6077. And then Treasury bonds, that was the other one. So I replied to a question on Treasury. Somebody asked for an update. Now, quite a bit recently I've covered that. My main focus is really on the long-term charts. I'm trying to pull it up here. Give me a second. Here we go. And I'm looking mainly at the interest rates for those Treasury bonds, and I've talked about that quite a bit. So the way I have the trend line drawn here on the monthly is you have TYX, the 30-year Treasury bond yield at that. Again, I just covered this the other day, but I don't mind doing it again. TNX, the 10-year yield, also at long-term. Not just a trend line, the trend line. These are the trend lines, the primary secular bear market downtrend lines and interest rates. Remember, the interest rates are an exact mirror of bond prices. So to be bearish rates, expecting a pullback in bond yields, means you expect a bounce in bonds. That correlation is immutable. It doesn't change. That's what bonds trade on, their rates. It's not like sometimes I talk about the relationship with the US dollar and gold, how the dollar goes down, gold will typically go up, but there are times that they both can go up and down together. That doesn't happen with interest rates on bonds. They will trade directly inversely to the rates. So that's it. So therefore, I'm giving it a little room, was my point. You have all the reasons that I've covered: overbought, these extreme overbought conditions, everything else. And then I do want to add to this that I've been told you for recent weeks now, my core holdings are short equities, long treasuries, and long bullish gold, right? Precious metals. But keep in mind that the treasury trade, more so than the gold trade, is pretty strongly correlated with the stock market. So although they are completely different asset classes, I mean, that's the key to asset allocation and diversification 101. The old school rule, is how much you're going to put in stocks and bonds. That's before. There's other little micro classes: real estate, gold, precious metal. But the big one, and this is what hedge funds, mutual funds, pension plans all go off of the asset allocation models, is for the most part how much into equities and how much into bonds. And that is because historically they tend to move inversely to one another. And there are times where they do move in sync, but overall, most of the time, 90% or so, they have an inverse correlation, and that's why a stock bond portfolio one will cushion the other. When your stock market corrects, the bonds then tend to rally, especially government bonds. There's a big difference too. I don't want to digress, but a junk bond is going to trade in line with equities, with stocks, not with treasuries. So don't confuse that. And then other corporate bonds, the investment grade, anywhere in between. It depends. Anywho, so that's it. TNX, and then of course FVX, the 5-year yield. And since we're looking at 30, 40-year plus monthly charts here, which is what we're looking at, again, I'm not trying to use this as an exact tactical trade. More of a strategic trade. Tactical might be short term, something I hit for 60-minute chart or 5-minute chart, in and out in a day or a few days. So I'm giving these a little room. But again, if I'm wrong on the stock market and we hold, the bulls defend the beachhead, meaning those key support levels, and we rally over the next few weeks and coming months here, guess what? Well, treasuries are probably going to go down. Yields will continue to rise. They'll do that because rallying stock market is indicative of future growth expectations being bullish. People wouldn't be buying stocks if they didn't think the economy was going to continue to expand and grow. Now, if that happens, the Fed then has to be more aggressive because that's going to lead to even worse inflation. So that's why it all ties in together. Technicals first and foremost for me, why I'm long bonds right now. just looking for a pullback. It may last for a few weeks, maybe even a couple months. So if my stock market scenario plays out and the bears are successful and take out those support levels and stock market drops, probably going to drop pretty hard and fast if I'm right. And if that happens, what you're going to see is a flight to safety into bonds. Here, we'll look at the bonds themselves. I know you're probably driving some of you crazy because you're not trading, you're not buying TNX or TYX. Here's TLT. This is the 30-year bond ETF. We've had some divergences along the way. None have stuck yet. But again, we weren't at that long-term resistance. So when you zoom down to 60-minute chart, we had bullish divergence recently, just like on the futures. And that if we make another low, that line shouldn't be there. Let me take that away. Extend the one that we had at this most recent low, and you can see if we have another jog down, we can still keep the divergence intact. It would look like this. If we make a marginal new low and then reverse, I'm drawing, this is your line tool, divergence will still be there. So there's a potential to rally. Look, I have these, but I'm really pressing. What I'm focusing most of my effort right now on is the stock market. But I do have these as well. And again, they're going to be most likely a correlated trade. In other words, I'm either wrong on one, I'm going to be wrong on both. So keep that in mind with your positioning. Because a portfolio that's 100% or 50% short the stock market and the other 50% of your money long bonds right now, government bonds, that's not as diversified as you might think it is because of that correlation. So I hope that makes sense. Let me look at the futures for you real quick, because that's where I trade. You're going to need leverage to make money on treasury bonds. They don't move up and down that much, especially compared to stocks. So that was it. I started buying them back here, getting bullish. We had a bullish falling wedge right there. Let me change this tool to a line, change my tool color so you can see it, and they're right there. A little bullish falling wedge break, fell shy of T1. The other bonds, and I've also made it very clear from that point and since that I've been favoring the shorter end of the yield curve. And so it's no surprise that the only one that didn't hit at least my first target was the 30-year bond, CB, which we're looking at. But what it did is the divergences continued to build, and that was right now, that's our divergent low right there, positive divergence. We've been walking our way up. We had a little trend line here that's been taken out, but again, I'm sticking with this one now, and I'm giving it room. I would even give it room for a marginal new low. But I'll tell you again, what happens next week may cause me to pivot. And by pivoting, I mean start to close out some or all my short exposure and possibly even go long, depending on what I see. And if that's the case, I may muck my hand here, which is a poker term for kind of throwing away your, folding, throwing your cards into the pile. ZN, looking for that. I've got tons of charts open down here where you can't see. Let me grab that. There it is, ZN. Nope, that's NQ. Bear with me, guys. If I can't find it here in a second, I will pause the video and look for it. There it is. ZN, same thing. CT1 was already hit right here, and we continued. We had positive, aka bullish divergence at that point. The divergence, just like CB, continued to grow, and so that is a big old divergent low here on the 60-minute chart. We broke that minor trend line there, and we've been working our way up. So if the market breaks down into next week, we'll probably head on up and hit that T1 again. We already hit it once, and more than likely to continue on up to these targets. If the bulls are successful and they hold the line, treasuries may just continue lower, and that's going to be because the Fed, Powell and the Fed will be forced to, we know we're going to get 50 basis points. It's more about what they're going to do next. And if the market thinks they're going to continue, maybe even follow up with another 50 basis point hike, then it's not going to be good for treasuries. ZF, the 5-year, again, that was where I was favoring and heaviest weighted. We hit our first and second target almost to the button, pulled back, same story, just like the other ones. Positive divergence, bigger wedge. So far, breakout, pull back, and if things go the way I think they will, by next week, I think we'll see if the market collapses, if we take out the support next week and have a big sell-off, which I certainly think is possible and likely if it's anything other than a false breakdown, a whipsaw, then this should happen quick move up to T3, my next target there, and then potentially T4 and T5. All right, guys, 30 minutes. I'm going to wrap it up here. Crude starting to, again, or starting to build a little steam to the downside. And again, that's not by mere coincidence. The equity market, this is NQ. Here's my 10-minute chart. Let me go to a 60-minute chart because I haven't actually, I used to cover these quite a bit until just the last couple of days. So let me just show you on a monthly chart. This is a 60-minute chart. Remember, we put in a divergent low right here just last week, or this week, April 27th. We rallied. That was Thursday. Had a nice rally. Took out the trend line, and this is indicative of a bear market. Usually, these 60-minute divergent lows are the catalyst for the move to new highs and beyond. But what's happening? This is indicative of bear market action. The sellers, any breakout is being met pretty aggressively with sellers stepping in. And the dip buyers are just getting, this is what happens. I talk about it. I use the analogies, in psychology. It's Pavlov and his dogs. He was the one that rang the bell. He'd feed the dogs, and then after a while, all he had to do was ring the bell, and they would salivate, even if he didn't put the food out, because they associate with the bell with food. And then, and that's Pavlov's dog. That's in the stock market. Every time there was a dip, the dip buyers would step in, they'd hear the bell, they were rewarded, and they got used to that. And then what happens, the other analogy I use is things start going in reverse. You get, here, let me show you, and then I'll wrap the video up. It's B.F. Skinner is the one that comes to mind. He's the one that did positive and negative reinforcement. Had the little box and the electroshock. Put the little treat. The rat would hit a button and get a treat. Hit the button and get the treat. After a while, rat would learn that he'd hit the button, he'd get a treat every time. Well, all of a sudden, then, you instead of a treat popping out, you put a little electroshock on when they press the button. The rat would get shocked. And first time a rat goes to hit the button, after a while, after being conditioned, he gets a shock. It's not nice, but guess what? He'll go back. He'll hit the button a few more times. Eventually he's going to stop hitting that button, or the red button, whatever it was. And so when you look at the stock market, let me just turn this off and go to here, turn off all the lines. Here's what's happened for the last 2 years. Fed came in, opened the punch bowl up, and all these dips, those buyers were rewarded. And so they did is what they've been doing, and buy the dips and buy the dips. But all of a sudden, the market starts to have a change of character, and then they realize what happens is, and everybody's different. Everyone has their own threshold. Some people may have already stopped, but I'll tell you, at this point, especially after this is where Elliott Wave comes in. You had that big rip up. You took out some previous highs, failed at that one. That is where the bulls really, at that point, there should have been at least a pullback off the 200s. But if this was a correction and it's over, there should have been a relatively minor retracement, and we should have gone on just like when COVID hit. You took the 200s back, just back here in 2018, that big Q4 drop, tested a few times, fell down, and then finally came back and took them up. So this to me is pretty bearish, the fact that we're back down to those lows, especially after putting a double bottom in. They are still there. The lows are still intact for now. And again, we'll see next week. All right, I will wrap it up here. This has been Randy Finney with Right Side of the Chart. If I don't do another one today, have a great weekend. And if there's a big move overnight in the futures over the weekend, I'll get something out, but really won't be a lot to be said. If the futures tank on Sunday, which wouldn't surprise me because that's the nature of a bear market. It likes to trap. It likes to trap longs. And deny shorts. I said I'd stop the video, but I like to reiterate this. These are the times where you're going to sometimes you get a big gap. And what it does is, those conservative shorts, they think that maybe they share my mindset, but they're just too conservative and they're going to wait for the breakdown. Sometimes they're denied on a big 4 or 5% gap down, and then they don't want to short. What they want at that point, I missed it. I'm not going to short with the market down so much. I'll wait for a back test of 317. Well, guess what? That back test never comes. That's the nature of a third wave down. And more importantly, remember, for every short seller in the market, even in a bear market, there's 100 or 1,000 or more times as many bulls or longs. And so what happens there as well, potentially, and that's something to look for next week, would be a gap down. And a gap down could get bought up, could go back above there. I addressed that already, but it uh, just as likely, if not more likely, will just continue to go down and deny. It will trap those longs that are maybe sweating it right now. But look, if you were a stock market bull and you held here, well, you're back to where you were. You didn't capitulate at that point, so they're probably going to still hold, and their pain threshold will probably be somewhere below there. And I can tell you there's probably a boatload of stop loss orders down there on longs that will likely get triggered, especially on a big gap down. And then all the good stuff comes into play. I'm talking as a bear, which is forced margin call selling. At the height of top of every bull market, including this one, I've shared the statistics, not recently, but margin debt reaches an extreme, and it was recently in all-time highs not too long ago. I forget exactly where it peaked. That means in a bull market, people buy more and more on margin, and that is 99 or well, good percentage long equities, not short, not in a bull market. It's all the way around the bear market. And then what happens is the beauty of margin calls, and that's why I like short selling. When you get those drops, it is common, more than common, to wipe out in just a matter of days or weeks, to wipe out months and sometimes years of gains. And if you don't believe it, just go back in time and look at the previous bear markets, and you'll see how quickly stocks can fall and wipe out years of gains in short order. All right, we'll wrap it up here, guys. Have a great weekend.